Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, what are pivot points? Many people think a pivot point, just in this last slide that I showed, this is a pivotal point area. This is where the market, after a rally, it came back, and that's a pivot low. That's a pivot high. Then the market swung up, and it formed a pivot high. It formed a pivot low, and then the market went up and now formed a pivot high. While that is true, these are areas of pivot support or pivot high or pivot swing points, as we call them. They're not the pivot points made and derived from the calculations that we are going to talk about today. The pivot points that we are going to talk about today are based off of a mathematical model, and they are used to trade in what I use. If you are a client of Thinkorswim, you have access for free of charge to my proprietary filtered pivots, which not only helps me uncover what condition the market's in, but under that condition, whether it's bullish or bearish, it gives me a clue, an insight into what the next time period's range might be. So we consider, or I consider, this a leading price indicator for traders. Now, there's a lot of folks that are using pivot analysis, and you will find that people talk about R3, and then they talk about the midpoints, and then you have R2 and another midpoint, and R1 and midpoint and pivot point and midpoint, and then the first target of support, and then the midpoint, and the second target of support, and another midpoint, and then finally S3. So you can go from S3 to R3 and everything in between. Quite frankly, I find this, as I've written here, burdensome and confusing. If I'm bullish and I'm looking at the market in an uptrend, let's look at this simple little bar chart together. What do we see? We see higher high, a higher low, a higher low, a higher high. So we see a sequence of higher highs and higher lows. Pretty bullish.
More importantly, look at the open-close relationship. The market closes higher than the open. The market closes higher than the open. The market closes higher than the open. And in this example, the closes are all closer to their highs. And mostly, and most important, the close is above past or prior highs. So therefore, this uptrend really is telling me that the market is in a very healthy incline, in a very strong uptrend. So at that point, if I'm looking to be a buyer, if I assume that sometimes the markets may open lower and trade higher, if I'm bullish, then perhaps the low will be here, and if we make a higher high, perhaps the high will be there. So let's just anticipate and see what we draw up. Well, look at this. If we're bullish, the market may just come up to go to looking like this, S1 to R2. So if I'm bullish in the marketplace, I don't need any of that crap on my screen. I just need, or perhaps I don't need any of this stuff. Perhaps I just need to look at the pivot point to S1 up to R2 if I'm bullish. One of the amazing things to me is that people use pivot analysis and they have pivot support targets on their line and they're bullish. And all of a sudden they go, you know what? The market's moving a little bit lower, moved a little bit higher. I think I'm going to get long and I'm going to put my stop underneath that swing low. By the way, I know that the pivot support's there, but there's no way the market's going to get there. And all of a sudden the market goes down, stops them out. Market goes back up. They get long again and they put their support, their stop right underneath the low. All of a sudden the market goes down and gets them. Finally, at the low, near that predicted pivot support, we see a high closed doji pattern. So instead of waiting patiently
and acting with discipline as a professional trader, waiting for the setup, the right setup, instead of catching the falling knife all the way down, if you can learn to look for price actions to reverse at once they attacked the pivot support, look for that high probability candle like that high closed doji, an HCD as we call it, that's when we can take action and then look for the market momentum to reverse, and then we're going to catch the right wave. That will keep you less defensive and more on the offensive. And that's how I like to utilize pivot support the correct way. In looking at pivot resistance, sometimes the market's so bearish it doesn't quite get to the resistance, but I like to see the market as it starts to build momentum and get up there. What happens if we see, as we've talked about today, a candle pattern like the low close doji, and all of a sudden you see a market that closes below the low of the doji? We should see now we're at or near pivot resistance that was predicted a day in advance. Now I can start to take action. If this is a weekly or a monthly pivot resistance, I know that perhaps if we get a daily low close doji pattern, a daily one, then maybe the market will start to see a regression in value or see the market move lower into a bearish condition. And then therefore I can start to examine looking at bearish option strategies, whether it's buying as a directional trader, by outright put options, or perhaps if I'm looking for the market to pause, to move a little bit lower, but certainly not advance, maybe I could look at some what I like to do, credit call spreads as well, and take in premium, where I definitely have a defined risk. More importantly, I do have a less than desirable but absolutely defined profit. So by selling the premium with some type of protection, and that's why when we look at certain trades, we like to see what can I get best for my money? What's the margin requirement? What's the risk? And what's the reward? And what's the probability that the outcome will be something that I'm desiring? Because let's say, for example, I think many traders are looking for big reversals, and they only get small reversals. They were right in the fact that the market didn't go any higher, but they were wrong in the sense that it really didn't go anywhere. So sometimes directional options, and I'm sure some of you guys and girls can agree, you've gotten out there and you look for these big market moves and you've bought put options and the market just didn't go down. It didn't go up, so you were half right, but you still lost money. So I think using pivot analysis can help you by targeting what the potential resistance level is, and then as an option trader, you can look to apply different strategies. And that's why I think it's really neat to how working with the ISE, they have so many other special guests that come on with different strategies and options, that theories that you can utilize. When I come on board and show you how to spot reversals, you can apply the techniques that I use to using different strategies that you can learn elsewhere. So it's a very powerful educational format the ISE has put together. And to be honest with you, I'm very glad to be a part of it.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.